So now when we turn to Europe, we always want to look at the cost of energy. And now as we get a rising call for a ban on Russian natural gas, Russian oil, it's important to put into perspective the costs. So public costs to alleviate high energy prices through March 2022, percentage of GDP. Now, this is going to continue to go up. And the problem is, as you increase the amount of capacity, and again, it could be done. It's not saying it can't be done, but when you're looking at oil, miles per ton is going to go up. And then there's a certain amount of limitation in terms of what capacity there is. So there's only so much that can be replaced. It's possible to a point because you're going to have that threshold. And the threshold is, well, is Germany going to Nigeria? Is it going to Angola? Is it going to Brazil to increase their flow to replace Urals? Then when you look at LNG, well, do they have a regasification facility? How high is the utilization currently? Is it at 37% or 100%? Because that's, again, these are some of those impacts. But regardless, say Germany can replace everything from Russia. Not that they can, and they can, but if they can replace everything, well, what does that cost? What is the miles per ton? What is the day rate, insurance? All of those things add up. So this is why when you look at a percentage of GDP, this all gets passed through because diesel is a pass-through, and that is really where that's going to hit the most. And where does the U.S. import from? Germany's a big, we buy a lot from Germany. That's going to get passed through. Again, all of these things continue to be an overhang, which is why when you look at Eurozone non-food goods consumption, you're seeing some of this slowdown. The non-food goods consumption proxy continues to weaken. And as prices grind higher, as you get these pressure points, that's where you're going to see more of that demand destruction, more of that, well, I just can't afford it. And that's where we think we're going to see on the non-food retail side, because I need to buy food. Food is getting more expensive. We showed that in segment one when we not only talked about, fertilizer and grain prices, but just also what it looks like in Europe and those underlying pressure points, which is all happening while German producer price index for industrial products is now over 30%. So PPI year over year was expected at 30%, came in at 30.9. Month over month was expected to be up 2.7, came in up 4.9%. Again, leading indicator for inflation, leading indicators. And now Lagarde essentially said that we're already in a recession, but we can't stop printing because if we do, it gets that much worse. Now, something like this, I mean, if you look going back to the 50s, this is the worst PPI they've ever had, which is going to call for more action, which is when you start looking at have we bottomed and the Eurozone expectations of growth and where they are. Obviously, the expectations of growth is more of the leading indicator. There is more pressure coming and there's nothing that is letting up. And again, leading to those pressure points, leading to those underlying problems, which is when you start looking at the household savings rate. Household savings rate is down to 13.3% in the euro area. Business profit share increased to 40.7%. The household saving rate in the euro area remains under pressure compared with 15% in the third quarter of 2021, approaching to the values observed right before the COVID-19 outbreak. This data came from a first release of seasonally adjusted quarterly European sector accounts from Eurostat. And it just means that this was 2021. So we still don't have Q1 2022 yet. So if we were already in this nosedive and then you had the Ukrainian war, the Ukrainian-Russia war, then you had prices increasing exponentially again, the savings rate is going to get even worse. So then when you start looking at the normalized index versus the Centex, the composite PMI, this is why we think we're already in a recession. You already have growth that is not slowing, but is going to be firmly negative either in March or April, depending on kind of when this really hits. But May and June, we expect to see more pain, more slowdown. And again, that's going to lead to the underlying issues. All the while, the employment rate and labor market slack has tightened. So where is there are you going to start to see a bit more wage pressure? Can you negotiate for a better wage? When you look at it, just inflation, it's spiraling. So how is that going to catch up? If it doesn't, which we don't think it really does to any meaningful way, because the wages were already weaker prior to COVID, never really recovered post the 2011 financial crisis in the European crisis. Spending never really recovered, and now they're just in a much worse place versus the U.S., which is why we think that Europe is already there. The U.S. is heading that direction. But again, this is why we're so concerned about global growth based on Europe and emerging markets. And then we think that continues to bleed through. And something that we think we're already seeing in Asia. And in the next segment, we're going to talk more about China and India, because that's the two spots that we think have the most near-term risk. But we'll, again, talk about that in a minute. I know the European segment was short. Not a lot of data came out. It was a pretty slow week. We will get more next week, and we'll make this segment a little bit longer, but it allows us more time to spend on Asia, because there's a lot going on, and there was a big data dump out of China this past week.